Hello! In this video we'll cover the third part of the allocation series, a three-part series. And specifically in part 3, we're talking about allocations related to book tax disparities. Now if you have not viewed the first two parts to the allocation series, please watch those, especially the first part. So if you recall, we're talking about allocations, not distributions with respect to partnerships. Okay, the tax consequences of allocations. So allocations are how exactly do partnerships, how do we allocate items of income, gain, deduction, loss, credit, whatnot, among or between the partners. And if you recall, under section 704, that's where we look, of the Internal Revenue Code, we are going to, the general document, the general rule is that we are going to respect whatever the partnership agreement states. However, under section 704B, the allocation will be respected as long as it meets substantial economic effect. Substantial economic effect. Now, what exactly substantial economic effect means, that's what we talked about in part 1 video. And please recall that there are certain special situations specifically related to non-recourse deductions and book tax disparities. This video will cover the book tax disparities. But the idea is that if you are allocated $1 with respect to taxes, so on paper, economically you better also be getting that dollar. Okay? If you recall in partnership tax, we do a lot of recording of capital accounts, the book, the accounting, right, the books, and also the tax numbers, tax basis, and whatnot. So the book allocation must equal the tax allocation. That's the key, the economics. Now, again, I mentioned that in part 2 we talked about non-recourse deductions. I'm not going to talk about non-recourse deductions in this video because it has nothing to do with the topic. All right? I'm going to explain how part 1 ties to part 3, why you can't have substantial economic effect, and that has to do with, again, this is when a partner contributes property to the partnership, whether upon formation or later on, and there is a disparity. There's almost always a disparity, meaning that the fair market value and the basis are not equal. So if you recall, when a partner contributes property to a partnership, there's no gain or loss to the partner or partnership. The partner takes a outside basis in the partnership interest equal to the basis of that piece of property. The partnership takes an inside basis equal to the adjusted basis of that partner with respect to that specific item. Now, another thing I want to mention is that in section 168, it specifically details that, and you're going to need to know this later on, it's 168I7, section 168, subsection I, paragraph 7, specifically states that not only when it comes to a partnership, the partnership steps into the shoes of the partner that contributed to the property with respect to the depreciation items. The depreciation items. So the method it was being depreciated and also the amount of years that are left in terms of depreciation. So if a partner has fully depreciated an asset, the partnership can no longer depreciate that asset. It's been fully depreciated. You don't get to just start fresh. The partnership does not. And this is something that's big when it comes to buying and selling a business. That's a benefit of when you're looking at a corporation, of someone buying a business. They're buying the assets of the business rather than stock, because the buyer actually gets to start fresh with respect to the depreciation, get those depreciation benefits. Versus stock, you don't get it, because stock you don't get to depreciate or amortize. So the issue becomes, we have this disparity between the fair market value and the tax basis. They don't equal. If they don't equal, it creates a potential disparity between the book numbers, let's call it X, and the tax numbers, let's call that Y, when you're doing the capital account recording. All right, and I'll do a simple example later to show you how you can have disparity. But when you have that disparity, you can't just simply allocate, very, very easily. You can't do that. Now, when it comes to book to tax disparity, there's two areas, and we're going to focus on the more difficult of the two. There's non-depreciable assets, which are usually pretty straightforward when it comes to looking at these methods. And there's depreciable property. We're going to focus on the depreciable property in this discussion for time's sake, because if you understand the idea behind the depreciable rules for book tax disparity allocation, you'll understand the non-depreciable because it's a lot easier than that. So the same disparity can occur upon book up to fair market value existing property in partnership, for example, upon admission of new partner. So if you recall previous discussion of revaluations, whenever a new partner enters the partnership, we have this issue where everything gets booked up to fair market value. That can create, because guess what? The book number could potentially be different than the tax number. And this is even when a partnership buys the actual item, not when it's been contributed. So the way that you know there's a book tax disparity is by calculating a built-in gain or built-in loss in a specific item. And the formula for that is book value minus basis. So we have our book number minus the tax basis in the item. If that gives you a difference, then when you do an allocation with respect to an item, whether it's depreciation or any cost recovery item with respect to that item, or you're actually getting rid of the item, you have to allocate according to the rules of book tax disparity. If you recall, the rules for the substantial economic effect are in Reg 1.704-1. NRD rules, which was our second set of videos, is -2, and the book tax disparity, which we're going to call 704C, is 1.704-3. So we're focusing on 1.704-3. Now, Section 704C basically brings light at this issue, specifically mentioning book tax disparity. So built-in gain loss can change over time, generally as book value and basis depreciate. So the book value can be going up because the value might be going up in a certain item, like a building, and the basis, or I'm sorry, if you have a book up, because you book up to fair market value, so it can be going up. But generally speaking, depreciation for tax and book purposes differs, so that can create a difference in these items. When you have that difference, again, you can't just simply allocate using normal means. So what you're going to see is that we have three ways to allocate under the regs. And this is the traditional method, the remedial method, which is known as traditional method with remedial allocations, and the curative method. These are the three, okay? Now, I want to note that the traditional method and the curative method can always be used. The remedial method, it depends. It depends on the circumstances. I'll explain that later on. So before we go into talking about these three methods, 'cause that's really the highlighting part of this whole discussion, I want to just highlight again how exactly you can have these kind of issues, how they pop up. So the book tax disparity is created because at the time of contribution or revaluation, so at time of contribution or revaluation, and a common time when a partnership has to revalue is when a new partner joins or a partner leaves a partnership. Revaluation must occur. The property must be reflected in the partnership's books as fair market value, even though no gain or loss is recognized for tax purposes. In effect, the gain or loss in the property is recognized for book purposes, but not for tax purposes. So it's saying that based on contribution revaluation, you got one book number that's different than the tax number with respect to that asset. They're different numbers. So X versus Y, they're different numbers. So substantial economic effect is based on book value, not tax basis. Therefore, allocations of built-in gain or loss cannot have substantial economic effect because we're looking at allocations with respect to tax, but substantial economic effect is based on book, and there's a disparity. That's a disparity. The substantial economic effect is based on book, but allocation on the tax allocation. The tax allocation. Tax. All right? So that's the key. That is the key piece of the why the book tax disparity comes up. Another thing that I want to highlight before we talk about the three different methods, we're going to go down the list in this order, and that's the way you always need to view these issues. And you're welcome. By the way, another thing I want to focus in on is that the partnership the partnership agreement can dictate which method to use for the partners. You have to be consistent. It's not like, oh, you pick one or the other, or you have to follow one or the other based on the situation. The partnership can pick any three of these. I will say a curative is going to be the most difficult, but it cures pretty much any situation. A lot of partnerships use the curative method because it prevents any issues, and you'll see why later on. So before we jump into going through these three methods, which is the heart of this discussion in the regs, I want to focus in on, to really understand this, please, please, please go through examples. Whether you have an instructor taking a class or whether you go online and just look at some examples of these three methods, it really helps. Of all of the three parts, this is probably the most important one to really go through examples, because once you see examples of numbers and and comprehensive example, you really it's really easy to grasp. It's very mechanical, lots of calculations, especially if you're dealing with lots of years, but it's really important to understand that if you see the numbers, then things will start making sense. It'll click, okay? Versus the other two parts, things get a little bit more dicey. All right. So the first method is a traditional method. The first method is a traditional method. The traditional method is the simplest. This is the simplest of the three methods. There's only 4 steps that you really have to follow in order for the traditional method. And the way that I'm basing my explanation of this is, first I'm going to talk about I'm going to first talk about the traditional method, and I don't have a slide talking about what exactly the general idea of the traditional method is, because the next two methods, they basically deviate. They take the traditional method and they deviate. They do something. So they take the simplest method and they deviate. So the one thing I want to say is that when you're looking at the book to tax disparity, again, and all of the examples and all the discussion we're talking about here, this applies to depreciable property. Again, we're not talking about non-depreciable in these steps. Okay, because you're going to see in the steps, it's assuming that you're talking about depreciable property because that's the more difficult of the type. So the idea, again, is that when you're looking at substantial economic effect, which a book to tax disparity, which we already discussed how that can happen, you can't have it because simply by the term book to tax disparity or book tax disparity, there is a disparity. They're not equal. If they're not equal, then guess what? So the key really is what do you follow? Well, you follow book. The allocation for tax purposes should follow book. Now the idea, and this is throughout the entire Internal Revenue Code, and basically Section 704C keeps this intact, is that the partner that is responsible for contributing the asset, or if there's a revaluation, the partners that were there before or will be there after a partner joins a partnership or leaves a partnership, they are responsible for the respective item. But let's just talk about, in our examples, partners that are contributing these assets to keep it as simple as possible, because I'm telling you it's already going to be quite confusing in a way. So partners contributing an asset that has its disparity. So let's say that in our example, we have two partners, A and B. A is going to contribute property with a value of $50. So this is depreciable property. Doesn't matter what it is. Let's just say it's equipment. $50 fair market value. And the adjusted basis will be $10. So of course the fair market value, that's going to be our book numbers, right? And the adjusted basis are our tax numbers. B though, just contributes $50 of cash. Now this is a 50-50 partnership. Everything is to be split equally 50-50. All right? Let's say in the first year, the partnership breaks even with everything. Okay? Breaks even with respect to everything except depreciation. So there's depreciation on this equipment that we have to allocate. Now if we do 50-50, right, for tax purposes, let's say that, and I remember I told you that the partner steps into the shoes of the partnership. So let's say this asset was purchased the same year, and let's say that for book and tax purposes, to keep it simple, it's 5 years. And let's also say, just for simplicity, for this example, I know this isn't realistic, let's just say it's straight line for both book and tax purposes. Straight line for both. Okay? Let's just do some general analysis here. So our book number right, is 50. 50 divided by 5 will be $10 per year for the entire partnership. So that'll be $5 per partner. Okay? However, with respect to the tax numbers, so that's a book. Let's put a line there so you don't confuse that. Tax, there's a $10 adjusted basis, which is taken over 5 years. So that's going to be $2 for the partnership, and it's going to be $1 per partner. $1 per partner if that's allocated out. Okay? We're just going to keep it for the entire partnership. $2 per year. Just keep that number there. Okay? So there's only $2 that can be allocated with respect to tax. That's the tax basis. So the traditional method, so with respect to substantial effect, we focus on the book. The book is the key. Because again, the tax allocation, which is what the issue is, needs to follow a book. Well, for book purposes, for financial accounting purposes, if this is what we follow, we do $5 per year per partner, $10 overall. Well, you see a disparity, right? We can only do $2 for tax purposes, but there's 10 for book purposes. So under the regs, in 1.704-3B, here's a summary of the steps to follow in allocating the depreciation under traditional method. Okay? This does not affect any other items. So first we calculate tax and book depreciation. We did this. Allocate the book depreciation among the partners. All right? So we allocate the book depreciation among the partners. So that means we do $5 a year per partner. So we basically determine the book numbers. So we use the $5 per year. We use that. So we calculate our book. So if you're keeping track of your book numbers, you subtract away $5 for depreciation. So the next step is first to consider, so now we're looking at tax. First consider the non-contributing partner. Here that's B. Why? Because A contributes the asset, B contributes cash. B is not contributing any asset that has that's disparity. That's the non-contributing partner. With respect to the asset that creates a Section 704C disparity and match the NCP's tax depreciation with book in step 2. So what they're saying is that B, so I'll do it right here, B has a book depreciation of 5, tax should also be 5. But we have an issue because there's only 2 of depreciation. So all 2 is going to be allocated to B. So if we had 5, all 5 would go to B, and then whatever's left, allocate any remaining tax depreciation to the contributing partner, to the one that contributes, which would be A. But guess what? B can only be allocated 2 because you can't create anything out of thin air under the traditional method. This is called the ceiling rule. And the traditional method respects the ceiling rule. The ceiling rule basically means is this situation right here. When the tax number is so low that the non-contributing partners can't get their full book amount, then the traditional method respects it and says, hey, we can't go any farther than the tax amount. We can't create anything out of thin air. That's the key. So that's how we do the allocation. So in this specific instance, B would get 2 for tax and A would get 0. Now, what if we change the numbers and let's say that the tax resulted in 7? Then B would get 7 here for the year. And these numbers are still the same. B would get all 5 and A would get anything remaining, so A would get 2. It has to equal out to the full amount. So the traditional method is pretty straightforward. The key, though, is this ceiling rule. And this is a huge issue because this, it happens so often and it limits it. And what it does is it creates a disparity for the end partner. You might be thinking, well, what about A? A doesn't have anything. It's not going to affect the basis. And again, if you see a full example of this, you can see why this makes such a big difference later on. But the key is that when you sell the property later on under Section 704C and the rules that are with respect to pre-contribution gain and loss, A is going to bear some type of gain or loss with respect to that pre-contribution item. That $40 of pre-contribution is going to be with respect to A. Okay, so that's really the traditional method. Again, I strongly recommend looking at some type of example to see this, how it plays out in multiple years and all different types of examples. Okay, I recommend looking at the book Logic of Subchapter K if that's not what you're your instructor is or whatever you're doing, if that's not what you're using. Okay, so the next method, this is method number 2. So each method gets progressively a little bit more difficult when it comes to the calculations. So the traditional method with curative allocations, also known as a curative method. So the traditional method of curative allocations basically starts out with the traditional method, the same idea. Starts out with the traditional method, and it adds a huge piece, okay? And I want to note again, I mentioned earlier that the traditional method with curative allocations, you can only use this in certain situations, so it depends. So the traditional method you could always use. The traditional method with curative allocations, it depends on the situation. So the curative allocations method permits the partnership to overcome the problem created by the ceiling rule. So we saw the ceiling rule in the previous example, and we're going to continue with this example. Okay? So B was not allocated 3, right? B should have been allocated 3, but what about that 3? It's going to mess up B's numbers, and it will. Okay? Basically, what it does is it creates a distortion later on where A, the contributing partner, actually gets the benefit of that loss later, with respect to when the asset is actually sold, just so you know. Okay, A is going to have to recover, or B is going to have to recover more gain upon sale, and A less gain if let's say there's a gain upon sale in the future. So this method, number 2, curative method, it cures the ceiling rule problem. So if there's no ceiling rule issue, then under the traditional method and traditional method of curative allocations, it equals the same. The partnership may use reasonable curative allocations of other partnership items to cure disparities created by the ceiling rule. Now, it's very important. This is the most important thing. This is why it depends. The only type of item you can cure with is an item that has the same character as the item that creates disparity. So what do I mean? Well, if you remember your rules of federal income tax, right, your basic rules, depreciation is considered ordinary, right? Depreciation is considered ordinary in nature. It's an ordinary character item. So you have to find something that's considered ordinary that's a gain. So depreciation is considered an ordinary loss deduction, right? If you're going to do this with respect to depreciation, you have to find character that's the same. So it has to be also ordinary. It has to be ordinary as well. We have to have some gain or income to offset. That's the idea. So you can only use this method if items of the same character available. If not, look to the remedial method if you're trying to cure the situation. Okay? Because the remedial method always works. All right? So, in our previous example, that $3 disparity, if there's $3 of ordinary income that happened during the year, or it has to be more than $3, because we allocate everything 50-50 in this partnership, right? 50-50, okay? Let's say that there's $10 of ordinary income, and that $10 of ordinary income would normally be $5 to A and $5 to B. Well, to cure this issue, what we can do is we can allocate 3 of that $5 that B would get to A, and we can create a -3 from that offsetting, because it offsets to 0, right? A -3, a +3, they net to 0. That's the idea. It nets out. Same character. That's why it has to be the same character. I know we're channeling our inner algebra here, like our algebra stuff, right? You can't create stuff out. It has to be the same character, same items. It nets out to 0 because you have $3 of this depreciation you're trying to create, right? That B's trying to get, and you're trying to give B $3 of ordinary loss through deduction, and you have to give A $3 of income. And what you can do is you can take that income from B, and by doing that, you can create a 0 offset because you can do another 3 here. Okay? That's really what you're doing. You're offsetting items of income from one taxpayer to the other. So A is going to have that, And by doing that, it offsets. Okay, it offsets. All right. It offsets to 0. Okay, and again, the best way to see it is again through an example. So let's go through the steps. So the 4 steps are the same. The first 4 steps are the same as the traditional method. This is the traditional method of curative allocations. This is method number 2. So we do the first 4 steps the same, just like we did. Then you calculate the subtotal. So step 5, calculate the subtotal and the capital account balances. So that's where we find out we have a $3 difference. We have $3 difference. Then we allocate book income of corresponding income gain among the partners. Okay? So for us, that was the $10 of the ordinary income item that we said, right? Which we said we're going to do 5 and 5. This is $10 of income that's ordinary. Let's say it's interest income, which is considered ordinary, right? Interest income is ordinary. So we do 5 to A, 5 to B. So we have this $3 difference. What we do is we reallocate 3 of that income over to the other. Over to the other person. So we first consider the non-contributing partners' amounts and allocate tax income of the corresponding income gain in order to make the NCPs, the non-contributing partners, end-of-year capital account balance equal at the end of the year's book capital account balance. So that's what you're doing. You're looking at the difference, but you can also do it by just simply looking at the capital account balances. You focus on what the book should be, the book. And you can offset that with respect to the other item. Again, I recommend going through an example to see that. And you allocate the remaining tax income, which would be at $3, right, to the other partner. So this would allow B to have book depreciation for the year of 5, tax depreciation for the year of 5, and then A, who is so B is a non-contributing partner, right? A is a contributing partner. A would have a book depreciation calculation of 5, but a tax amount of 0. This is respect to depreciation. Yes, A also has 3 income that's offset from here, right? From A. So we use something else to offset so that B could get that $3 change amount. Okay? And this disparity right here will balance out in the end. Because when A sells the property, that gain will still be there. That original $40 that was inherent, that will be there. It will still be there. Again, look at an example to see. Okay, so we're on the third method, the remedial method. So the remedial method always works. This one always works. This is the most difficult of the 3 methods. So basically what this one does is it's similar to the traditional method of curative allocations, except instead of looking for the same character, it simply creates a nominal item to offset of the same character. And it uses that to offset the other partner to give the non-contributing partner the amount. So it does not result in the same amount as this. People think, okay, the traditional method of curative allocations and the remedial method will result in the same numbers. In the end, it does, yes. After the item has been fully depreciated and the item has been sold, yes, it does. Because both of them cure the issue. This one creates different numbers when it comes to looking at capital accounts. Okay? So the way it does is it's a 2-step process. First, an amount of the book value equal to the adjusted basis of the contributed property is recovered over the remaining cost recovery period of the property. The remaining book value is recovered over a new capital recovery period determined as if the partnership purchased the property on the date of contribution. So remember, we said that the partnership steps into the shoes. So the partnership steps into the shoes of the partner. This method says, for tax purposes, it's as if the partnership is buying new. This is what creates a different amount than the traditional method with curative allocations, because you're using different depreciation numbers. Okay? This one you really need to look at an example to see what I'm talking about. It's really, it really helps. And when you're going through the example, please use my steps, step by step. So the tax items are allocated to the partners in the same manner as under the traditional method. So we do that. The tax item is allocated to a non-contributing partner to the extent of the partner's share of the book item. So again, we still focus on book. When the ceiling rule limits an allocation because the tax item is less than book, the non-contributing partner receives a notional or a nominal. Sorry, I said no, nominal. Nominal is nothing. Sorry, it's notional. Nominal, it balances to zero. Okay, so what I mean by nominal is it balances, or notional, it balances to zero. Just like we saw the $3 of offset, right, in the character. Same thing, except it's a completely fictitious amount. So a synonym for that would be it's fictitious. Okay, so the contributing partner is thereupon allocated an offsetting tax item in the same amount. So it's fictitious. And it is the same character as well. Same amount and same character. So this method is preferable over the traditional method of curative allocations because what if you don't have an item of the same character? This one creates it fictitiously for the other partner. So here are the steps, and this is really what you should focus on because this method of the three methods is by far the most challenging to do. But once you go through it a few times, it's really good. So you need to break up the pre-contribution gain or loss asset up into two components. First, the original asset as if the contributing partner kept the asset and continued depreciating. And second, the additional value asset created by booking up the asset. So what we're saying here is we've got the $50 fair market value, depreciable, right? And we have the $10 adjusted basis. This $40 difference, this is that second part. This is that second part they're referring to. Okay? The second part there. So the first component is that 10, the original asset, if it's as if the contributing partner kept the asset and continued depreciating. So we're talking about for tax purposes here. That's one thing students and practitioners always confuse. When I know, yeah, we always focus on book, but this is really tax. I mean, you have to look at the book because you have to look at this distinction. And the second is the additional value, that 40 asset created by booking up the asset. So it's as if the partnership bought it new, they would get that full $50 of depreciation for tax purposes. Then we calculate tax and book depreciation using the different recovery periods for each asset. So what we do is we base the $10 and the $40, we do book tax, book tax. Okay, so the third step now is allocate the book depreciation among the partners. We've done that before. The fourth is first consider the non-contributing partner with respect to the asset that creates the Section 704C disparity, and the NCP, the non-contributing partner's tax depreciation, should match step 2. This is where it starts getting dicey. You have to allocate any remaining tax depreciation to the contributing partner. We've done that. Calculate the subtotal. Once you do that, you'll have the disparity, and that's where you see the difference. Now we allocate a fictitious item of tax loss in order to make the non-contributing partner's end-of-year tax capital balance equal to the end-of-year book capital account balance. Note the character of this loss is the same as the pre-contribution asset's character. So the character is the same. I mentioned that. It's possible that no item is needed in this step in certain years. You might have no adjustment here. So that's one thing I want to note, is that under the remedial method, in different years, you can have different nominal amounts or fictitious amounts, right? Different amounts. So you got to be careful. In my experience with the traditional method, it's the same amount of allocation each year because you're keeping that same calculation. The reason why you have different amounts is if you look back on the previous slide, we have two different determinations, two different items that we're determining here, right? We're breaking the asset into two parts. The economical part and the tax part. Sorry, this is the book amount, not the tax amount. Sorry about that. So that 40 is the book amount that's come about from it. Okay? And then number 8, we allocate a fictitious item of tax income to the contributing partner. So we do loss to the non-contributing partner to balance it out, and then we do fictitious item of tax income to the contributing partner in the same amount as the NCP. This results in a net out to 0. That's why I call it nominal earlier. Note the character is the same as the pre-contribution assets character. It's possible no item is needed. So the idea is it's very similar to the other method, right? The traditional method of cure of allocations. The key distinction is that your numbers can change in multiple years. You can always have this notional amount because it balances to zero. And again, you break the asset into two parts. This portion, like it's like two different types of assets, if you will. Okay. So with that being said, again, it's really important to go through some examples. Use these steps to really focus in on when you go through it. I promise you, it will help you understand the steps in order to do this process.